On July 8, 2026, a sudden shift in international relations impacted global energy markets. Donald Trump announced the termination of the temporary ceasefire agreement with Iran. This decision led to an immediate decline in shipping traffic through the Strait of Hormuz, causing Brent crude oil prices to bounce from technical support back to $78 per barrel. Investors are monitoring the situation as rising energy costs introduce new inflation concerns into the macroeconomic landscape. The Strait of Hormuz is one of the world's most critical transit corridors, handling a significant portion of global petroleum shipments. Following the end of the ceasefire, maritime tracking data indicated a notable drop in tanker activity as shippers assessed security conditions. Shipping carriers have increased their risk premiums, reflecting concerns that regional transit bottlenecks could persist and keep energy costs elevated. Adding to the macro volatility, the Federal Reserve released the minutes from its June monetary policy meeting. The document revealed that participants explicitly removed all language that previously suggested a bias towards future interest rate cuts. By stripping out easing projections, the Fed signaled a hawkish stance that aims to keep rates at elevated levels for a longer period. During their discussions, Fed participants noted that the balance of risks to inflation remains skewed to the upside. They identified several key drivers, including the potential implementation of new tariffs, rising energy and commodity costs, and the substantial energy demands associated with artificial intelligence infrastructure. This hawkish outlook pushed bond yields higher, with the 10-year U.S. Treasury yield rising. The combination of rising bond yields and geopolitical energy pressures weighed on equity markets. The Nasdaq 100 experienced a technical breakdown, falling below its 50-day moving average and logging an intraday lower low. Market analysts pointed out that this break occurred on weak volume and declining breadth, indicating that the index tape lacks strong institutional buying support at these levels. Despite the broader market selling pressure, specific technology companies showed resilience. Apple announced a new multi-year strategic agreement with Broadcom, valued at more than $30 billion. The partnership focuses on the supply of custom silicon chips and wireless connectivity components, providing Broadcom with long-term revenue security. The agreement with Apple highlights Broadcom's expanding position in the custom application-specific integrated circuit, or ASIC, market. As tech companies design specialized chips to handle advanced workloads, Broadcom's design flow secures its role as a key infrastructure provider, offsetting the volatility seen in standard semiconductor markets. Nvidia also received positive news regarding its export market. Industry reports suggest that Chinese technology companies, including Alibaba, ByteDance, and DeepSeek, may receive regulatory approval to purchase up to 200,000 units of Nvidia's H200 chips. This potential volume helps stabilize demand projections for Nvidia's hardware in the Chinese market, despite trade restrictions. As institutional investors rebalance their portfolios, Nvidia has functioned as a defensive anchor within the technology sector. Due to recent price adjustments, Nvidia's forward price-to-earnings multiple has compressed to approximately 18 times. This multiple sits below the S&P 500's average of 20 times, attracting buyer support at key technical levels. Contrasting this technology optimism, Michael Burry, the investor known for anticipating the 2008 housing crash, has increased his short positions against semiconductors. Burry pointed to South Korea's massive planned $500 billion investment in a chip manufacturing megacluster as a sign of peak capital cycle oversupply, suggesting that excessive industry investments historically lead to market tops and margin compression. Concerns are also emerging in the shadow banking system. HSBC has halted credit renewals and restricted lending to riskier private credit funds. The bank's decision follows write-downs on individual loans that were posted as collateral, indicating that traditional lenders are reducing their exposure as underwriting standards in the private debt market deteriorate. This tightening of credit by banks contrasts with public credit market indicators. Sizable passive retirement inflows continue to flood into fixed allocation funds, keeping public high-yield bond spreads tight. This creates a divergence between public credit metrics and the underlying stress developing within private lending channels. As capital rotates away from concentrated mega-cap technology names, other parts of the market have shown relative strength. In the first half of the year, the small-cap Russell 2000 outperformed mega-caps by a 12% spread. This performance suggests a broadening of the equity rally as investors search for value beyond the largest technology leaders.